Today, my guest is Ted Lanzaro. Ted's based in Cheshire, Connecticut. He's a CPA with Lanzaro CPA, and he's a real estate investor. He's also the author of the Tax Smart Landlord. And today we're going to talk with him about some of the tax benefits of real estate and what you can do to help yourself. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. We would love to hear from you. You can like, share, subscribe, and comment. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and that's under Commercial Real Estate Pro Network. With that, I want to welcome my guest, Ted. Welcome to CREPN Radio.
Hey, Darren, thanks for having me. I really appreciate it.
I'm delighted to have a chance to speak with you today, and looking forward to talking a little bit about some of the benefits of real estate and tax consequences. But before we do that, if you could just take a minute and share with the listeners a little bit about your background.
So I have been a CPA for 29 years, and I started my career working for a larger firm where I was in the tax department, and I was working with a lot of commercial building owners, a lot of developers, and other types of investors, and doing tax returns, tax preparation, tax planning for those people. And around 2002, I said to myself, I like what these people are doing. They're making money, and it's kind of cool. And maybe I should consider doing some of my own investing. So I went out and I started to buy some rental properties in Fort Lauderdale, Florida, and got some buddies together, and we threw some money together. We went out, we bought some properties, and as a result of that, I started going to these real estate investment club and landlord meetings and stuff because I wanted to know more about what we were doing. And people found out that I was a CPA and working, with other investors and working and reviewing all of the laws for my own situation. And they said, can you do a presentation for our group? And, the first time I ever did it, it's like one of those, knees are shaking and, you're not even sure what you're talking about and you're reading off of, PowerPoints and stuff. But after a while, I got the hang of it. And after the first one, I was surrounded by people who all wanted to be clients. I'm like, wow, this is really great. And the bonus of that was having connections with other investors made me a better investor and a better CPA because, I learned so much about what everyone else was doing. And this was at a time where, at least in South Florida, people were flipping land, right?
Right.
Building lots. They were buying pre-construction. This was one of these kind of weird markets where people made money doing some stuff that probably you can't really do now. But yeah, it was kind of interesting and learned a lot.
No, that's awesome. So were you working down in Florida at the time, or were you?
Yeah, I lived and worked down in Southeast Florida at the time.
Gotcha. Well, that's great. So you started off as a CPA working with investors, and then you got in yourself, and then started talking at the REIA groups and picked up some clients. Can you describe your portfolio, or kind of was it single families, or what were you investing in?
Yeah. So I started with single families, buying single family houses down in Fort Lauderdale. And then it moved into buying and renovating both single family and multifamily properties. And that turned into buying and doing some small syndications on some garden apartments that exist down there. These sort of like 1-story U-shaped, 12 units kind of apartment buildings they exist down in Fort Lauderdale, Hollywood area. And And then in 2005, I decided to move back to Connecticut. I was originally from Stamford, Connecticut, and I decided to move back to Connecticut. So my partners basically bought me out of our portfolio that we had built, and I moved up here. And when I moved up to Connecticut, I started doing the same thing. I bought and was rehabbing single family and multifamily properties. Then I got involved. The busier I get now, the more I'm involved in just being like sort of a more passive investor, investing in other people's syndications. Occasionally, I'll get an opportunity to put some money into like a commercial building or a shopping center. So that's kind of what I'm doing now.
That's great. I mean, you clearly have kind of the whole smorgasbord of experience in as far as being an active, hands-on investor, and then now as passive. And you said you've done some syndications as well. It's I think that'd be a big help for any of your um, accounting tax clients that are in real estate.
Yeah, and that's the whole thing. I mean, my experience, my personal experience, compounded with all of the different clients that I've worked with, which has been everything from the guy who owns a two-family house down the street to billionaire mall developers. So it really spans the globe. And right now, my client base includes a lot of residential syndication, but also a lot of commercial office buildings, a lot of shopping centers, and some that are privately owned, some that have been syndicated.
No, that's great. Um, so, as an investor, you're saying that's a big help for you with working with investors. I mean, you are one of them. Um, what I mean, there's two things. I guess there's two directions I'm thinking of on where to go here, because I think one is a lot of times the overall topic is, man, the benefits of having real estate for your, when you're filing your taxes. We could go down that. But I think one of the things I wanted to start with is, and maybe it's easier to answer the other one first, but what are some things that people that invest or haven't been using a CPA, that I guess what I'm trying to say is, what are some things you see that people are missing when they're or is it basically you start with people from the beginning and you take care of them?
Well, I think it works both ways. I mean, a lot of times we're not starting at the beginning. We're starting, somewhere in the middle, and these people have established portfolios. And the biggest mistake that I see people making is kind of twofold. One, they're not taking advantage of the rules as they relate to depreciation. So they're not doing cost segregation. They're not writing off assets they're abandoning. They're not taking advantage of the tax code that they could be. And it's because they may have a very good CPA, but they don't have a CPA who is a real estate investor and a real estate specific CPA. So, there's a lot of great CPAs out there, and a lot of them are generalists, or they might be specialized in a different area, like, they could be manufacturing or financial services or whatever. This is all I do. I only do real estate. So I know all the rules, and I help my clients, basically tailor those rules to their specific situation, because, there's a lot of strategy, and we'll use cost segregation just as one. I could look at one person's scenario and say, yeah, cost segregation is awesome for you, and you should definitely be doing it. And I could look at another person's scenario and say, no, that's not the right strategy for you. You're not in a situation to take advantage of that. So my approach is specifically to tailor the strategies that I use and that are included in the Tax Smart Landlord book to the person's individual situation.
Got it. And as far as the different types of situations in a general scope, does that have to do with whether or not they're professional or passive, or along those lines?
Yeah, that's exactly what it is. You know, there's three kinds of investors, and you have your passive investors, and those are the people who might like invest in the syndication or do what I'm doing, where I don't have any say. You know, I'm just putting my money in, and hoping for a good return. Um, in that scenario, you're not allowed to take um, losses against your ordinary income. You can get to zero, but you can't do any better than that. And so you might be able to get cash flow and then bring your net income, net rental income down to zero, but you can't offset. I can't offset my CPA income, for example.
Right.
I can offset other rental income, but I can't offset my CPA income. Then there's active investors, and those investors can deduct up to $25,000 a year of rental losses, primarily from depreciation, um, against their ordinary income if they have adjusted gross income of less than $100,000 a year. Okay, so as they earn, for every dollar over $100,000 they earn, they lose 50 cents of that $25,000 ability to deduct. So if they make $120,000 a year, they can only deduct $15,000 a year of rental losses. So those people quickly phase out. By the time they get to 150, they're phased out. So in a lot of cases, those are the investors that I'm dealing with, who have high income. So they may be, a doctor or a lawyer who owns some rental properties, and the strategy with them is different than the strategy would be with a real estate broker who's a professional. So when you have that professional status, in other words, professional status is, hey, I work in the real estate industry. I spend over 750 hours a year managing my properties, and that's more than half of my total activity as an employee or business owner. So with that, you have to be careful, one, because there's an election that you have to make to aggregate all of your activities. Otherwise, it's 750 hours of property, right? Which is basically would be impossible. So one, you have to aggregate that. Two, you have to make that election. And three, the thing that I tell my clients is you better be tracking it, because it's one of the things that the IRS will look at. If you claim professional status, you take a big loss, you might get called into an IRS's office under audit, and the first thing they're going to ask for is your time log showing, how did you come up with the fact that you qualify, right? So I'll give you an example. I have a lady who I know has a 2,080 hour, 40-hour a week job, is working 2,080 hours a year as an IT consultant. And she calls me and she says, I want to show myself as a real estate professional this year. And I said, there's no possible way we can do that. I worked 2,000 plus hours in my real estate business also. And she is a part-time agent and an investor. Well, I'm like, well, you want me to go and tell the IRS that you work 4,500 hours a year? I said, that's kind of, that's insane, right? So she's like, well, if you won't do it, I'll do it myself. So she basically took her return back and she went and she did it herself. And 2 years later, she called me and she's like, I got a call from an IRS agent. In this case, it was in New Haven, Connecticut, where we live. And they're challenging my real estate status. And would you be willing to go down there and help me out? And I said, well, I can't help you out. I told you were wrong. And, there's nothing I could really do. And you don't need a CPA anymore. Now you need a lawyer, right? So,
right.
There's nothing, but those are, that's the kind of thing you have to watch out for. You really want to make sure that, one, you qualify, and two, that you're tracking it properly.
So let me ask you on the, as a passive investor in a syndication like you're doing now, if the syndicator does a cost segregation study, my understanding is that you don't lose that depreciation, but can you not use it against the disposition, the sale proceeds?
Yeah, absolutely. So you get the you get the benefit of it to the extent it brings you to zero, right?
Yeah.
Then the rest of it carries over to the following year, and the following year, and the following year, until one of two things happens. You either start getting, because at some point the property will mature, so it'll start generating actual income, at which point you would use your carryovers to offset that income. Or when the property sells, you're able to use that entire carryover against whatever capital gains you're allocated.
Got it. Got it. Now, I hear the praises of depreciation always being talked about, and clearly, for somebody that's looking for a way to pay less tax, that's a neat way to do that. But if you're in this situation where you're a high earner and you're passively investing, I think just the understanding of how that that affects you is something that's not always explained well or talked about. It seems like a lot of times it's run past, or like, and I've always been kind of like, well, wait a minute here. I think there's a piece that's missing, or we're not hearing the whole thing there, but I appreciate you going into that.
Yeah, I mean, think about it from this standpoint. The whole point of investing in real estate is to generate cash flow, right? So you generate cash flow, and to the extent that you do, and you can offset it with depreciation expense, meaning that you might make $20,000 worth of cash flow, but your K1 says zero on it, right? Well, I've got $20,000 in my pocket, but I didn't have to pay taxes on that $20,000. Now,
Right.
it is a deferral game, because somewhere down the road, right, I'm going to run out of depreciation and I'm going to have income that I have to pay taxes on. So you don't completely eliminate it, but you defer it, and you defer it in a way that the current time value of money, it's more beneficial to defer it in year one and end up paying the taxes in year 20 than it is the other way around, because the money's more valuable in the current year.
Right. No, and I think that is spot on. To get the cash as soon as you can, kind of thing, makes complete sense. What are some other? I mean, depreciation seems to be the one that's, I think probably one of the more focused points as far as benefits go. Are there some other points that you find that investors are not, aware of or taking advantage of?
Yeah. Well, in the Tax Smart Landlord book, we talk about all of the kind of administrative kind of expenses that people, overlook when they do. That's the second mistake that we were talking about mistakes before. That's the second mistake that a lot of people make, which is they don't deduct all of the expenses that they're entitled to. So there's a whole list of things that you can deduct as an investor, and everybody knows, like, for example, everybody knows you deduct your mortgage interest and your real estate taxes, insurance, repairs, that sort of thing, the property specific kind of stuff. But a lot of people miss the fact that, just as an example, you can deduct the miles that you drive when you're managing your properties. Now, if you're running a big commercial real estate company or whatever, your company's probably paying for your car anyway, right? But if you're a smaller investor who maybe is running a portfolio of small commercial properties in town, and they're running around in their car, visiting the properties and checking in with their tenants, and doing some of the management kind of stuff, it's very easy to leave those miles off. And let's say you drive 12,000 miles a year doing that. That's a $6,000 tax deduction, right? And probably more. Right. It's more than 6 cents, 54 cents a mile. So it's a little more than $6,000 in tax deduction. Here in Connecticut, we're paying tax at 30+% if you make good money. So that could be $2,000 or $3,000 of tax benefit that you're you're leaving on the table.
Yeah, just giving it away, right?
You basically are, right? And even as a passive investor, what I tell people, even if you're a passive investor and you can't get the benefit in the current year, you still want to take all of those expenses and let them build up as part of the carryover. Because when you go to use that carryover, now let's say you sell the property 10, 15 years from now, and you've added $2,000 a year of those kind of expenses um, to your return. And let's say it's 10, you've owned the property for 10 years, that's another $20,000 of capital gain you're going to offset just by being diligent about, deducting all of your expenses.
Right. No, and I think I'm so glad you're bringing this up, because I think that a lot of times I've heard people like, it's just more hassle than it's worth. But like you said, the cumulative effect and the gain you're going to have when you sell, if you don't do 1031, you're going to have an issue there, and that's when it's going to be of value to you. So that's great.
Yeah, exactly.
Yeah. So let me ask you, 'cause you indicated in the beginning that you had gotten out of the deals that you were down in, or that you were involved in and down in Florida. So if I understand right, you've gotten in and you've gotten out of properties. Did you 1031, or did you settle up on taxes, or how did you
Yeah,
move?
no, I actually, in that scenario, we were very fortunate because I did get out at a good point, at a high point in 2005. The market in South Florida was very hot. I got out at a high point, and I paid the taxes. Yeah, I
Okay.
did pay the taxes.
Okay. And so let me ask you this, because I think that, again, the benefits I hear people talk about, and, people are like, I need to get in real estate. I need to get in real estate. What are some cautionary tales, or, I mean, you mentioned about the professional. If you're not a professional, you can't be a professional. But just the getting out of a property, and I guess that's really where I'm thinking when I'm asking this question is, when you go to sell, and if you're in like a syndication, doing a 1031 exchange, as I understand, can be a little challenging. Can you speak to any of the things to be aware of that you see that would give people at least not necessarily a reason not to do real estate, but something to make certain that they're aware of, and possibly have a strategy conversation with somebody like you, or their CPA?
Yeah. Well, when somebody's looking to sell a property, I always tell them, look, there's four times you want to call me: when you buy a property, when you're renovating a property, when you sell a property, and before year end. So let's talk about when you sell a property. The first thing is, well, what's my gain, right? That's the first thing we always try to figure out. What is my actual gain on the sale of this property? And let's say it's because sometimes people have no idea what their gain is. Let's put it that way, right? So then we go and calculate it, and it turns out they really didn't make that much money. Okay, well, now you got to make a decision. You got to make a decision, because you're not going to do a 1031 exchange to defer 15 grand of capital gain, right?
Right.
But now we figure out. Let's say we figure it out, and it's $500,000, right? And I had the situation not long ago where a father and son had a situation where they owned a property they were going to sell, and the tax effect, not the gain, the actual tax effect, was $500,000 in taxes to each one of them. And the son and the father weren't getting along. So they didn't want to do a 1031. In other words, they didn't want to do a 1031 exchange into a larger property, because the son didn't want to do business with his father anymore. So he was willing to pay the $500,000 tax, not to have to do business with his father. And so what we figured out was that if they titled the property differently and literally like split their interest, they were able to do a 1031 exchange each separately, and not be under the rule that if you sell it in an entity, you have to do an exchange in that entity. So they basically retitled the property, and were able to basically split it for purposes of doing a 1031 exchange. So the son was able to do an exchange, and the father, I don't know what the father did because I didn't represent the father, but the son, he was willing to pay the taxes in order not to do business with his father anymore. I thought that was amazing.
Yeah, something didn't go well there.
Right. Yeah.
How common is it that you see people configure prior to sell so they're able to do that? Is that kind of more on a partnership thing, or do you see that happening with syndications?
I don't see it happening with syndications because, in that scenario, the limited partner doesn't really have the ability to force the entity to break everybody out separately. So
Right.
that wouldn't be an option in that scenario. I don't see it very often. That was a pretty specific, situation that required us to do a little legwork quickly in order to help this particular guy. I think the biggest issue right now with 1031 exchanges is finding properties, finding good properties, right? Because
Right.
you've got time limitations. You've got 45 days to identify, 180 days to close. You've got to be able to find a property that makes sense. So in a lot of cases, and I know a lot of people who've chosen just to pay the tax instead of rolling it into a property that is not as good as the property they had. So if you've got a property that you're selling that you were making 12% on, why would you want to buy a property you're going to trade up to a property you're going to make 5% on?
Right.
Doesn't always necessarily make sense.
Right. No, I wonder if you could speak to, and I've heard others talk about, some other vehicles, trust, and even like I think it's a Delaware statutory trust kind of thing. Have you had any clients go into those out of a sale as opposed to, paying the tax or doing a 1031?
Yeah, I just, matter of fact, it's interesting because I just had a client who is actually in the process of doing that. He's using is selling a property and going to use the Delaware statutory trust to do the 1031. I'd be honest with you, I don't know a whole lot about that, but he sent me some research on it. I hadn't had a chance to look at it yet, but he seemed very confident that it was going to work for him. He's a real estate broker.
Right, right. No, I've heard of them, and I've talked with a couple of guys, and I think that from what I gather, it's a way to accomplish 1031 of sorts, or essentially defer the tax again. So, but I
Yeah.
gotcha.
I see more people going into these kind of triple net kind of passive deals that in a lot of cases are like, I'm gonna own the building that Red Lobster is gonna, rent from me for, 40 years, or, a pharmacy, CVS or Rite Aid or something like that is gonna buy and rent long term, and it's triple net, and they buy the property and you get your 5 or 6% return. There's companies that specialize in selling those to investors.
Yeah, and the thing that's interesting to me, and I didn't it didn't occur to me. You could probably speak to it more as an accountant, but as an investor or landlord myself, I've always thought of the benefit of having the real estate. Um, can you speak at all as to why it's beneficial for big companies like that to not own the real estate, like the Walgreens and that?
Yeah, I mean, I'm not sure exactly why they do that, to be honest with you, but I just, for example, I have a client that just bought a bunch of post offices, right? And he's leasing them to the United States government,
Hmm.
right? So why doesn't the government want to own their own post offices? I'm not sure. They're triple net deals, so they're paying the repairs, and they're paying the insurance and taxes and all of that. Um, I'm really not sure, to be honest with you, because some other businesses that, like, for example, McDonald's, I mean, McDonald's is a real estate business. It's not
Right,
really, they sell hamburgers, but they're in the real estate
right,
business.
right, right, right. No, I've always kind of been fascinated by that based on, the equity build over time. Um, and, I guess the way it's been explained to me is that just to get that long-term debt off their books and make them more liquid, I guess, is kind of what would have been, or was
That may
suggested.
very well be the reason. Yeah.
But got it. Ted, if we could, I'd like to shift gears here real quick. Before we started the call, I mentioned to you, by day, I'm an insurance broker, and we deal with risk management. And the three strategies that we employ are typically we look at either can we avoid the risk, that'd be the first, can we minimize the risk, that'd be the second, and then the third strategy would be can we transfer the risk, and that's where an insurance policy comes in. And I've been asking my guests if they could um, provide an answer to what they see as the biggest risk. And I'm not looking necessarily for an insurance related answer. I've recognized that risk is it's everywhere. But if you're up for it, I'd like to ask you, Ted Lanzaro, what is the biggest risk?
The biggest risk that I see for real estate investors right now has to do with state legislators making laws that are um, anti-landlord, essentially. Okay, and a lot of this is primarily in the residential market. But like, for example, here in Connecticut, there's legislation right now that would make a landlord 100% liable for lead paint poisoning in um, their apartment buildings. So if someone, and this is sad stuff, and you obviously want to avoid this happening, but to make the landlord 100% liable for something like that happens, um, and it's done in such a way that it may not have been their fault. In other words, like they may have already done a remediation, but then something happens, and but they're still 100% liable. So those kind of there's other laws that restrict the amount of rent you can charge. There's some laws pending that would change Section 8 programs. So it's all of these kind of legislative initiatives that I feel are a big threat to landlords.
No, I appreciate you sharing that. And I know anybody in Oregon would probably share your sentiment. They've gone and made essentially rent control, um, throughout the state here in Oregon, and it's I think that the sad thing is a lot of it's been a reaction to an economic event that wasn't caused by the landlords. It was the loose banking standards, that basically had increased the number of homeowners beyond what the model had always supported, and consequently there were some banking things going on there that caused that. But anyway, how the landlords now become the bullseye for some of these things has been frustrating. But that lead paint thing you talk about, I know here in Oregon too, we've got there's some efforts to identify masonry non-reinforced masonry buildings. That's what it is, based on the earthquake exposure. And you take lead paint or whatever that building's made out of. If you think you have a housing shortage currently, if you're essentially taking that stock out of, or those buildings out of the rental stock, that's not going to help the situation. So it seems like a kind of an interesting ploy from the legislatures.
Yeah, and think about it from this standpoint, right? I think you're absolutely right. And to the extent that it costs landlords more dollars, right? So, for example, we also are seeing licensing fees and things So there's several cities here in Connecticut that are charging, you have to register each of your properties with the town, and there's a fee that's associated with that. So now the fee, the landlord doesn't, the landlord has the choice of either making less money or passing along the fee, right? Just like any other business would do, they're going to probably try to, whatever extent they can, to pass along the fee. So now the rents are more expensive. The housing stock is the price of that stock is going up, right? And then so now you have less and less people who can afford to possibly live in those units, and now you have what you're doing is you're creating, a housing shortage for low income people. It's interesting, but I had like one guy say to me, if they pass this initiative, the lead paint one, he's like, I'm getting out of the business. So how many? And this guy owns 50, 60 properties. So how many guys like that does it take, right?
Yeah, no, it is just kind of mind blowing when you look at, you've got a problem, and instead of trying to increase the supply, essentially they're sending signals to landlords or potential landlords that it's not profitable to do business here. I don't know. It's been kind of an interesting time to watch, and I think that a lot of the measures or the efforts come from a place of trying to solve a problem, but I don't think they're fully thought out, I guess is what I'm coming to. So
yeah, no, I agree with that. There's look. I mean, I don't think they're being the legislators just they don't know enough to make about the business to make great decisions. And that's where, and we talk about this at meetings and stuff, real estate investor meetings, where we actually have, some lobbying groups of landlords that will go up and speak to here in Connecticut, the state legislature and tell them, look, here's the problems that we're facing. We know you're trying to solve tenant-related problems, but here's the landlord side of that. And somewhere in the middle is a happy medium that allows us all to do business and for people to live in these properties safely, right? Because that is a goal. We don't want, nobody wants kids to get lead poisoning, But the other side of that is how do you put things in place that are win-win, right?
Right.
Win for the tenant, win for the landlord.
Right. Ted, where can the listeners go if they'd like to connect with you and or learn more?
Well, they can go to my website, which is www.lanzarocpa.com, and I'll spell that out, LANZAROCPA.com. My office number here in Connecticut is 203-922-1742. And my email is ted@lanzarocpa.com. I consult with real estate investors all over the country and use all kinds of technology in order to do that. So anybody who is interested in talking with me, that's how I can be reached.
That's great. And I will have all that listed in the show notes in case you're listening and not able to take that down right now. So take a look at the show notes and we'll have that for you there. Ted, I want to say thanks again for taking the time. I've enjoyed talking with you and learned a lot, and would love to do it again sometime.
That sounds great, and vice versa. I'm going to be doing something podcasts and some shows soon. I'd love to have you on.
Hey, let me know and we will set it up.
All right, thanks, great.
All right. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.